Welcome everybody to Options Trading, brought to you by Alpha Traders. In this video, we are going to talk about advanced options. We're only going to take a quick look. Obviously, advanced options is well beyond the scope of sort of an intro to options trading course. But you should be aware of what they are, because there is a gigantic rabbit hole of options trading and advanced options and the things that you can do with options. As you'll see in a couple slides here, just the tip of the iceberg is really calls and puts. But they are the bread and butter, and they are the decidingly overwhelming decision for most traders. Just a straight up call or a straight up put, and usually just in abundance of them, 5, 10, 15, 20, blah, blah, blah. Right. So anyway, this is 8 of 9 of the videos. The next video will be the last video. So let's dive right into advanced options. Buying calls and puts are considered the bread and butter, but they are truly only the tip of the iceberg when it comes to options. Trading advanced options is well beyond the scope of this video, but let's run through some available strategies. So yes, you could buy calls, you could buy puts, but you can also sell calls and you can also sell puts. Selling is considered writing, as you are technically creating the options contract in the first place. So if you're wondering who you were buying all these calls and buying all these puts from, somebody had to write them. Somebody had to back that position up with an obligation to fulfill it if you were to execute it. Now, here we go in the next line. That does also mean that you are obligated to fulfill the option if the buyer of the option is to execute their options contract. So these can become very, very, very tricky and very, very, very pricey if you're on the wrong side of that contract. And now all of a sudden you have to fulfill somebody's AMD order of 100 shares that you were not prepared to buy for them. If the option is to expire worthless, then the writer keeps the premium that the seller paid for the options contract. So remember how we talked about your $690 for AMD expiring worthless? Well, that guy got paid $690 and he's keeping that money. An options trader can also buy and sell multiple options in the same options chain, creating option legs. If you remember back to the terminology video, we talked about options chain and we talked about legs. We talked about how you can have multiple options, buys and sells within the same order to create a strategy. These types of strategies try to protect the trader, but there's usually some kind of trade-off, such as limited upside. Now you have to remember, if you buy an options contract long, you're long AMD. All right, you're long AMD for, again, November 20th, 2020, and you bought super low. Maybe you bought last year, and you bought with a $10 strike rate. That option might be worth $100,000, right? Because it's going to go up and up and up and up and up so long as you're in the money. So there's potentially an infinite amount of upside, right? There is no limited upside. However, a lot of these strategies we're going to talk about, these limit your upside. These actually have a cap on your upside, but at the same token, they also limit your downside. So where you can get into situations and options where you can end up getting called, you can get margin called, you can be put in the hot seat saying that you owe, $250,000 in order to execute this particular option. It went the wrong way and you were the writer, then, that's really bad. So you can also protect yourself from downside exposure, but you'll usually have some type of cap or some limited cap to the high side. No longer infinite. Maybe you can only make $100, maybe $10,000, maybe $100,000, but they're usually a limit. All right. These option strategies are fairly basic, but they each serve their own purpose, and that is spreads, straddles, and strangles. I know, some strange names here. Now, spreads. Let's talk about spreads real quick. Vertical spreads. Vertical spreads are constructed using options of the same asset. So it's AMD with the same expiration month. So AMD, I'm taking in the November 20th, 2020 expiration, but I'm going to get one at, $80. I'm going to get one at $90, right? That's considered a vertical spread. It's a spread of the strike price. Same asset, same expiration, same everything, except the strike is different. Now, a horizontal spread, or commonly called a calendar spread. These are constructed using options of the same asset, again, AMD, with the same strike price this time. So let's say $90 call with different expiration dates. So I'll get the November 20th, 2020, and then let's say I'll get one in December of 2020, both at $90. And then diagonal spreads are created using option of the same asset, but different strike price with different expiration dates. All right, now straddles and strangles. So a straddle can be constructed by buying both a put option and a call option for an asset with the same strike price and the same expiration date. And we'll discuss why somebody would even do this in the first place in just a second. Now, a strangle is a strangle can be constructed by buying both a put option and a call option for the asset with a different strike price and the same expiration date. So let's talk about why you would even do this. These strategies are best used when the trader feels that a big move is coming, but they aren't positive on the direction. For these to be profitable, the gains must outweigh the losses for the combination of the contract. So, for example, these are very, very, very common if you're playing ERs. And ERs are earnings reports. So every 3 months or so, you'll have 4 quarters in the year, and you'll have an earnings report. And that earnings report essentially covers the financials, revenue in, money spent out. And then the other really important subject to look at is called guidance. And guidance is a look ahead. The next quarter is what the next quarter is going to look like, what the next 2 quarters, what the end of the year is going to look like. And these are for investors. They do a phone call and the whole 9 yards, and everybody talks about, where they feel their company's going, so that the investors or shareholders feel like they can either make money on them, or they want to hold them for dividends, or they want to make it sound juicy so that everybody buys them and ends up, blowing up their evaluation. So anyway, make a long story short, sometimes an earnings report can be highly volatile. And you can see assets jump, 10, 15, 20, 25%, or you can see them drop, 50%. And this is in the traditional market. That's how crazy things can be. What some option traders will do, they will buy a call, and they'll buy a put, and they'll buy it at the same strike price. Or they'll lean one way or the other. Again, you'll have the same expiration date. So you'll say, all right, well, earnings is coming out, let's say November 10th. I'm going to get the option just after that. So I'll get that November 20th option. And then this way I got some flexibility within the move. The earnings comes out, and it's a total doozy, right? And they dump 50%. What's going to happen is my call option will likely expire worthless. If it's worth anything, I could try to sell that real quick and maybe recoup 30, 40, 50%. But my put option is going to be so far in the money, it outweighs any losses that I would have taken. So it covers my losses from the wrong direction one, which was the call, and ends up being an insanely good trade. So that is one of the reasons you could do a straddle or a strangle. Now, straddles and strangles, they join condors, butterflies, and ratios when it comes to neutral strategies or strategies that are really focused around volatility. Now, these strategies are, again, usually focused around volatility, but can also be profitable if the asset is to just not move at all in price. That's where some condors, butterflies, especially ratios, come in, where you're making money if it doesn't hit these levels. So if you have a strategy that says AMD neutral at 85 and it's in at 83, you might have a strategy that says if it can't dip below 80 and it can't push above 85, you're going to make money. And you can make money on both sides on that. So options does give you that luxury of being able to trade a particular asset if it doesn't move. And that's incredible. That's incredibly flexible compared to the traditional stock market, where you need a direction. You're either going to long the market, you're going to short the market, long the asset, short the asset. So you need a direction. Generally speaking, you're not making any money if it's not moving. You buy AMD at $50, and at the end of the day, it's still $50. You didn't lose anything, right? But you didn't really make anything. And chances are you did lose a little bit from fees. So that's where you can really harness some of the advanced stuff when it comes to options trading. Now, some more advanced options that you may hear within your travels as you go down the rabbit hole of advanced options: covered calls, married puts, protective collar, iron condor, iron butterfly, strip, and strap plays. Now, again, these are just the tip of the iceberg. There are many more strategies out there for long, short, and neutral positions in the market, as well as protective positions and synthetic positions. So first, master the calls and puts before diving in too deep into the abyss that options trading can lead you down to. That was a quick look at advanced options. This is options trading, brought to you by Signal Profits. The next and last video will be mostly tips, tricks, keys, 10 keys to remember as you go down the path of options trading. Thank you for joining, and we will see you on the next video.